Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Hi, hope all of you are doing well. So the schedule of this week's webinar are at 10 a.m. we have risk and return, why endowment policies may not deliver. At 11 a.m. we have overview of India's engineering, research and development sector. At 12 p.m. we have NFO review, should you invest in NFO. So please attend these webinars and please share the link to your known circles as well so that if you think they would benefit.
In this video, we are going to talk about leverage and how it is like playing with fire. There's been a lot of talk about F&O trading, leverage trading. So let's first try to understand what is leverage. Leverage is a way for us to magnify our exposure to a particular idea. That is, normally if I had to buy a stock, I would have to pay the price of the stock. But if I am able to take leverage, I pay less than the whole price and I get more exposure to that particular stock. In today's market, there are many ways to achieve leverage. One is through futures and options, where you can buy contracts that actually represent much larger exposure to that underlying security. The second is through margin trading, where you can pledge your holdings and using that cash as a loan, you can actually buy other securities. There are also other ways in which you can borrow and increase your exposure. But the underlying principle is that you put in some of your own money, you get money from another source and you pay interest on that money that you get from the other source to make returns in the market. From this entire leverage trade setup, there are three observations that we can make, and let's look at how the math works on these three observations. The first observation is that when you take leverage, your returns actually get magnified. This is what drives a lot of people to take leverage calls, because they are able to realize much higher returns with a small investment of their capital. You can see why this is an attractive wealth creation strategy for retail investors. So in this table, what we are showing you is if you put in 10 rupees of your own money and 90 rupees through leverage, that is a 9 times leverage, your return can actually go up to 110% if the investment made a 20% return and your cost of borrowing is 10%. Now, taking these same assumptions into the second observation, what we will realize is that leverage also magnifies our losses, right? So if we look at that same 9 times leverage scenario, you will see that the loss is actually 190%. So you lose twice what you put in at a 10% loss. We are not even looking at a 20% loss. The third situation is that you assume that you're making the same 20% return and you have the same leverage structure, but your cost of leverage really comes down. Then you'll realize that funding costs actually can magnify your returns as well. So the lower your funding cost is, the higher your returns can be. Now, when we look at these three tables, we start to notice some patterns and we can take some knowledge away from this. So the first thing that we need to realize is that the losses that come from leverage are actually much higher than the gains. So if we compare table 2 with table 1, we will realize that for a 10% loss, you make a 190% negative return at a 9% leverage, whereas for a 20% return, you're only making a 110% positive return. So clearly that gap is much wider. So your tolerance for losses is very limited. The second point that we can take away is that many investors underestimate how much their leverage is costing them, right? So let me give you a very simple example. If someone were to offer you a personal loan at 20%, you would realize that you're paying a lot of interest. But if they said, we'll charge you only 0.05% a day compounded through the year, what do you think that cost would work out to be? These two loan rates are identical. They both work out to be roughly the same figure. But when we see a small number like 0.05% on a daily basis, we are trapped into this illusion thinking that we can pay this money off and it's only for a few days. So the real question is, where do we go from here? The first thing that we can take heart in is that the regulator has stepped in and has started talking very vocally about how F&O is affecting retail investors, and not in a positive way. The SEBI study showed that 90% of investors have actually lost money in F&O trades, and it's not a small sum, right? There's been a lot of dialogue around this, which has made investors a little bit more aware of the risks that are involved. The second and the most important thing that any investor or trader can do today is to look at the math. We've done a simple illustration here. It's very easy to calculate what your leveraged returns or losses are going to be. You just have to plug in your numbers and see whether that's the risk that you would like to take today. The objective behind this video is to ensure that you have a safe and successful journey as an investor, and we hope that it has contributed to your wealth creation journey.